You know, in the world of global business, rules are always changing. Most of the time, it's just minor tweaks, but every once in a while, a change comes along that quietly but totally reshapes the landscape for thousands of companies. Today, we're digging into one of those big, quiet changes, a brand new accounting standard called IFRS 19.
To really get why this new rule is such a big deal, we have to start with a kind of strange puzzle. Picture a massive global corporation, right? Now picture one of its smallest subsidiaries. I'm talking like a local sales office. Why on earth would that tiny office have to follow the exact same, incredibly complex and super expensive accounting rules as its giant parent company? That's the core problem we're going to unpack today.
So to get to the bottom of this, let's first take a look at the world of financial reporting before this new standard showed up. It was a world with one very big rulebook.
For years, the gold standard for global accounting has been IFRS, the International Financial Reporting Standards. And the whole point is consistency, right? So an investor in Tokyo can look at the books of a company in Brazil and it all makes sense. But here's the catch. This rulebook is massive, and it's always been this one-size-fits-all deal, which created a literal mountain of paperwork and a huge cost, especially for the little guys in the group.
And this is where you can really see how weird the old system was. A huge parent company has a high compliance burden. Okay, that makes sense. But a small subsidiary often had a burden that was almost just as high. They were forced to produce these incredibly detailed financial statements, even when the only one reading them was their own parent company, who, by the way, already had all the info. It just didn't make sense. It was expensive and, frankly, a huge waste of time.
So, with that problem just sitting there for years, the rule makers have finally stepped in with a solution. A new, much simpler standard designed specifically for these smaller companies.
And here it is, IFRS 19. The International Accounting Standards Board, the IASB, officially put this out in May of 2024. Now, it's officially set to kick in on January 1st, 2027, but, and this is the good part, companies can actually choose to start using it early if they want to.
So what does it actually do?
Well, the most important thing to know is that IFRS 19 is totally optional. Nobody has to use it. Think of the main IFRS rules as this massive, busy highway. IFRS 19 is like a brand new off-ramp that lets certain companies bypass the worst of the traffic, specifically all those complex disclosure requirements. And when I say bypass, I mean it. The amount of simplification here is just huge. I mean, look at this list. And this isn't even all of them. It cuts down the paperwork for some of the trickiest areas in accounting, like financial instruments, revenue, income taxes, you name it. It's a massive streamlining effort, all packed into this one new rule.
Okay, so you're probably thinking, this sounds great, but who gets to take this new, simpler off-ramp? Well, the standard is super specific about who's in and who's out.
It really comes down to three simple tests. First, you have to be a subsidiary. That's a given. Second, you can't have public accountability. And don't worry, we'll break that down in just a second. And third, your parent company has to be using the full main IFRS standards and publishing those financial statements for everyone to see.
Right, that second point is the big one. It's one of those bits of accounting jargon that can sound confusing, so let's just clear it up. What does it actually mean for a company to have no public accountability?
It's actually a lot simpler than it sounds. A company is considered publicly accountable if one of two things is true. Either its stocks or bonds are traded on a public market, like a stock exchange, or its main job is to hold financial assets for other people. Think banks, credit unions, insurance companies. If a subsidiary doesn't do either of those things, it generally passes this key test. Simple as that.
All right, so for a company that decides to take this off-ramp and use IFRS 19, what's the real trade-off? It's really important to understand what changes, and just as important, what stays exactly the same.
And this is the most important takeaway. IFRS 19 does not change the core accounting. The fundamental rules for how you recognize a sale or measure the value of an asset, all of that stays exactly the same as for the parent company. The only thing that changes is the disclosures. You know those pages and pages of notes that go after the main financial statements? IFRS 19 basically just slashes those requirements.
Let's use a real-world example to make it clear. Under the old rules, a standard called IAS 12 forced a company to write this really detailed note explaining all the evidence for why it could recognize something called a deferred tax asset. It's technical, it's a pain, and it takes time. Under IFRS 19, poof, that specific disclosure is just gone.
And that's just one example out of hundreds.
So it really just boils down to this. You keep doing the same core accounting, so everything stays consistent. But you get to stop doing the vast majority of that detailed, time-consuming disclosure work that other standards demand. You get the same quality of accounting with way less paperwork. Okay, let's zoom out for a minute. We've talked about the what and the how. Now let's talk about the why. Why does a change like this really matter in the grand scheme of things? Well, the benefits are pretty huge. For businesses, this is a no-brainer. It directly cuts costs and saves a ton of time on compliance. It also helps the financial reports for these subsidiaries focus on what's actually important, what's really material, without all the extra clutter. And at the end of the day, it just makes the whole system of global standards a lot more practical.
And if you need just one number to really appreciate the scale of this simplification, here it is. This one new standard provides relief from disclosure requirements that were buried in over 30 other separate IFRS and IAS standards. That is a massive step towards making global accounting rules smarter, not just harder.
And all of this leaves us with a really fascinating final thought. For decades, the big idea was to have one single universal rulebook for absolutely everyone. But IFRS 19, this shows a real shift toward tailoring those rules for different kinds of companies. So the big question we're left with is this. Is this just a one-off, or is tailored reporting the future for global standards? It's a trend we're definitely going to be watching.